Good evening, ladies and gentlemen. Hello and welcome. I'm Tim Congdon. I'm chair of the Institute of International Monetary Research at the University of Buckingham, which I founded in 2014. And it's my honour and pleasure to introduce Professor Willem Buiter, who will soon give you the Institute's sixth public lecture on economic policy. We're very lucky to have him. Willem is remarkable, to a remarkable extent, a citizen of the world. He was born in the Netherlands, but is a citizen of both the USA and the United Kingdom, and has contributed in significant ways to economic policy making in those two countries. He was a member of the first group of economists on the Bank of England's Monetary Policy Committee in 1997, having previously been chief economist at the European Bank for Reconstruction and Development. He was global chief economist at Citigroup, almost a decade, from 2010 to 2018. Must have been a fascinating time, and then their special economic advisor for another year after that. Willem has been a professor at the universities of Cambridge and Bristol, London School of Economics, Yale, and Princeton. I can say, well, that is wow. Ladies and gentlemen, I'll now chip into a secret, which I've actually already seen and read Willem's lecture. It's a feast of insights and provocations. Perhaps I may share one morsel with you. Willem is worried about governments bossing central banks around. And in one memorable phrase, he describes the central bank, a few hundred miles from here, as having become the de facto captive of fiscally weak sovereigns. You can probably guess what that central bank is. If you think that's a bit rude, let me assure you that Willem is very even-handed in all this, and he's reprimanded the Federal Reserve and ticked off the Bank of England as well. So, ladies and gentlemen, a big hand for Willem Buiter. Thank you.
Thank you for that very kind introduction. It's an honor and a pleasure to be here. It's going to be way too long for a lot of time, so I will speed through quite a few of the slides, but you can read them in the privacy of your own boudoirs. Okay, let's go again. Advanced economy central banks face at least three challenges. I left out the one of crypto here, which is for another lecture. One, how to relearn to control inflation when the shocks that are producing it are unlike any shocks that we have seen since the 70s. Sudden and dramatic temporary changes, COVID, Ukraine, gradual and secular changes, demographics, deglobalization, or what I would call the bifurcation of the world economy, climate change and the public and private response to it. Second, the overriding mandate of a central bank, whatever the official mandate is financial stability. The pursuit of financial stability can, however, at times get in the way, at least temporarily, of the price stability mandate of the central bank. We've seen an illustration of that in the last few weeks in the United Kingdom. And finally, resisting fiscal dominance, or fiscal capture, I think is a better way of describing what I have in mind, which means that you give the central bank the right and the ability to say no to a request for monetization of public sector deficits. Okay, onwards. The inflation record since the first quarter of 2021 in the advanced economies is pretty miserable. US, even the preferred measure, PCE, core inflation, is running at 4.9%, headline CPI 8.2%, Euro area 10%, core 4.8%. The UK, the winner of this moment, 10.1 for the CPI and 6.5 for the core. The index, including housing cost, is slightly lower, but it's still a miserable story. Even Japan has inflation, core inflation, slightly above target. So the country where all laws of monetary economics appear to be suspended is showing signs of life again. And then Canada, all right. The good news is that inflation expectations, at least when it comes to long-term inflation expectations, are still anchored somewhere near the target. Short-term inflation expectations have come down as well. I have the US figures here, 5.4% in September for 1 year. 3-year, 2.9%, also down. And then the 5-year forward inflation expectation, 2.38%. That was on October 14th, but whatever. And then the 10-year break-even inflation rate, 2.4%. So long-term inflation expectations have not yet become unanchored. So the time to act is now, before they too become unanchored, and the output and unemployment cost of bringing down inflation in a lasting way is going to be significantly higher. So let's move now. Well, why aren't we moving? The neutral policy rate is my estimate now 2.5%. I give you a neutral short real rate of 2%, of 0.5%, sorry, and then 2% for the target inflation rate. Only the Fed is actually at the beginnings of the restrictive territory here. The ECB, at 1.25%, is so far behind that they would be overtaken themselves if they were on the athletic track. The Bank of England, 2.25%, they're timidly knocking at the door of moving into restrictive territory. Bank of Japan, still at minus 0.1%, and the 10-year target has not been changed either. Bank of Canada, 3.25%. This is all, I think, slightly incompetent. These rates should be higher, and they also, in my view, will go higher, although probably still not fast enough. A useful benchmark, which Charles Goodhart has also used, is the Taylor rule, which has the policy rate as the neutral rate, 2.5%, plus some coefficient, alpha, times the gap between actual and target inflation, plus another coefficient, beta, times the percentage difference between actual and potential real GDP. Right? I'm going to just do the old style static Taylor rule here to get a benchmark for where, ignoring financial stability considerations here, interest rates should be. Alpha 1.5, it has to be larger than 1 for higher actual inflation to increase the real policy rate and therefore to restrain demand. And I'm assuming it's a neutral rate of 2.5%. Goodhart did this exercise, it was in early 2022, I think, right? Yes. And came out with a US rate of 6% and for the UK, 5%. My numbers are slightly higher. You can see it actually, yes. The winner is the Bank of England, even though I use everywhere the lowest possible inflation rate as the actual inflation rate. In other words, I use target, so I use core inflation, and in the case of the US, core personal consumer expenditure deflator. So the lowest core inflation rates available. Turns out that the rates should be, as in the second column under I percentage term, and the rates actually are is in brackets behind them. And now, I am not recommending here that the Fed at the next meeting moves to 6.85% or that the Bank of England moves to 8%. Advanced economy central banks face at least 3 challenges. I left out the one of crypto here, which is for another lecture. One, how do we learn to control inflation when the shocks that are producing it are unlike any shocks that we have seen since the 70s. Sudden and dramatic temporary changes, COVID, Ukraine, gradual and secular changes, demographics, deglobalization, or what I would call the bifurcation of the world economy, climate change and the public and private response to it. Second, the overriding mandate of a central bank, whatever the official mandate is financial stability. The pursuit of financial stability can, however, at times get in the way, at least temporarily, of the price stability mandate of the central bank. We've seen an illustration of that in the last few weeks in the United Kingdom. And finally, resisting fiscal dominance or fiscal capture, I think is a better way of describing what I have in mind, which means that you give the central bank the right and the ability to say no to a request for monetization of public sector deficits. Okay, onwards. The inflation record since the first quarter of 2021 in the advanced economies is pretty miserable. US, even the preferred measure, PCE, core inflation, is running at 4.9%, headline CPI 8.2%, Euro area 10%, core 4.8%. The UK, the winner of this moment, 10.1 for the CPI and 6.5 for the core. The index including housing cost is slightly lower, but it's still a miserable story. Even Japan has inflation, core inflation, slightly above target. So the country where all laws of monetary economics appear to be suspended is showing signs of life again. And then Canada, all right. The good news is that inflation expectations, at least when it comes to long-term inflation expectations, are still anchored somewhere near the target. Short-term inflation expectations have come down as well. I have the US figures here, 5.4% in September for 1 year. 3-year, 2.9%, also down. And then the 5-year forward inflation expectation, 2.38%. That was on October 14th, but whatever. And then the 10-year break-even inflation rate, 2.4%. So long-term inflation expectations have not yet become unanchored. So the time to act is now, before they too become unanchored, and the output and unemployment cost of bringing down inflation in a lasting way is going to be significantly higher. So let's move now. Well, why aren't we moving? The neutral policy rate is my estimate now 2.5%. I give you a neutral short real rate of 2%, of 0.5%, sorry, and then 2% for the target inflation rate. Only the Fed is actually at the beginnings of the restrictive territory here. The ECB, at 1.25%, is so far behind that they would be overtaken themselves if they were on the athletic track. The Bank of England, 2.25%, they're timidly knocking at the door of moving into restrictive territory. Bank of Japan, still at minus 0.1%, and the 10-year target has not been changed either. Bank of Canada, 3.25%. This is all, I think, slightly incompetent. These rates should be higher, and they also, in my view, will go higher, although probably still not fast enough. A useful benchmark, which Charles Goodhart has also used, is the Taylor rule, which has the policy rate as the neutral rate, 2.5%, plus some coefficient alpha times the gap between actual and target inflation, plus another coefficient, beta, times the percentage difference between actual and potential real GDP. Right? I'm going to just do the old style static Taylor rule here to get a benchmark for where, ignoring financial stability considerations here, interest rates should be. Alpha 1.5, it has to be larger than 1 for higher actual inflation to increase the real policy rate and therefore to restrain demand. And I'm assuming it's a neutral rate of 2.5%. Goodhart did this exercise, it was in early 2022, I think, right? Yes. And came out with the US rate of 6% and for the UK 5%. My numbers are slightly higher. You can see it actually, yes. The winner is the Bank of England, even though I use everywhere the lowest possible inflation rate as the actual inflation rate. In other words, I use target, so I use core inflation, and in the case of the US, core personal consumer expenditure deflator. So the lowest core inflation rates available. Turns out that the rates should be, as in the second column under I percentage term, and the rates actually are is in brackets behind them. And now, I am not recommending here that the Fed at the next meeting moves to 6.85% or that the Bank of England moves to 8.75%. Only would be a 6.5% increase. But I think this is a useful benchmark, and it tells us that even the Bank of Japan, right, is now behind the inflation curve by 320 basis points according to the Phillips curve. Now, I will give you the fact that you cannot take the Phillips curve literally, especially when it comes to the speed of rate hikes. That's why a Taylor rule with a lag built in gives you slightly more realistic time series for the policy rates. But I think policy rates everywhere in the advanced economies are still way too low. Why are the central banks so far behind the curve? Well, persistent errors in analysis and forecasting. They really screwed up. Right? Partly not surprising because the shocks, combined demand and supply shocks, were unlike anything we'd seen since the 70s. And indeed, some of the temporary and transitory narrative had merit to it. There was the statistical base effect. There were temporary labor supply reductions and supply chain disruptions caused by the COVID pandemic, which are reversible. And Russia's invasion of Ukraine was not expected to have us here in late October 2014, still worry about gas and electricity supplies. So there were some real surprises there, but it can't be blamed for. But there's also a failure to look at long-term supply scarring effects of COVID, so excess mortality in the US through low labor force participation and an increase in frictional and structural unemployment. In China, of course, the cost of the zero COVID pandemic. Deglobalization is a significant downward pressure factor for global productivity growth. The desire, very wisely, to build redundancy to supply chains is another source of recorded productivity declines. Demographics, population aging, and climate change all weigh on the long-term supply side of the economy. So why are central banks so far behind the curve? In addition to getting it wrong, right, as they all did, right? But there's more than that. I think there's fear of financial stability from rapid policy rate hikes and large asset sales. There's the fear of international repercussions, which, although I don't think this restrains rate hikes as much as it ought to in some circumstances. The fear of complicating the fundamental fiscal deficits and adding to the interest burden of servicing the public debt. So fiscal capture. I think it is present in the Eurozone, and it may be present also in weaker forms in other advanced economies. And finally, there simply is an unwillingness to engineer the slowdown in aggregate demand, most likely a recession, in some cases in the UK a deep recession, required to achieve a sustainable reduction in the inflation rate. So people hope for PID, a painless or immaculate disinflation. Well, it's not on the menu, I'm afraid. Okay, as regards the enhanced lender of last resort, the market maker of last resort, as I already said, financial stability is the overriding mandate of any central bank, because you can't have price stability without financial stability, or you can't have the dual mandate without financial stability. And we have the lender of last resort providing funding liquidity, the market maker of last resort, or really the buyer of last resort, providing market liquidity through outright purchases of selected systemically important financial instruments. Because of the growing importance of non-bank financial intermediaries, we need more attention by central banks to the proper functioning of key financial markets. That means we have an enhanced lender of last resort, making loans to a wider range of counterparties against a broader range of acceptable collateral, and the market maker of last resort outright purchasing a wider collection of instruments. Just to show you that we're talking corporate bonds here. The Euro system, the Fed, the Bank of England, the Riksbank, the Bank of Canada, between the, this is since, actually I should have the, I think this is all for the post-COVID period. Although this is the, yeah, these are all post-COVID programs. They have about 4,000 corporate bonds purchased among them. So not all of this was market maker of last resort activity, restoring functioning to malfunction systemic markets, but it really is quite a remarkable set of numbers, and it's not going to go away. So as I said, market illiquidity can be addressed directly by outright purchases by the central bank, but it can also be done indirectly as an enhanced lender of last resort by the central bank lending to a dysfunctional market maker or to the normal purchasing parties that have somehow been frightened out of the market. Two examples are the asset-backed commercial paper money market fund liquidity facility, too long a name for any facility that, and the money market mutual fund liquidity facility of the US. So you don't have to purchase the stuff outright. You can lend to banks or other market makers to encourage them to restore liquidity to malfunctioning systemic markets. The lessons that I hope we have learned is that the enhanced lender of last resort and market maker of last resort has to be the central bank, because it has to have infinitely elastic supply capacity for a domestic currency asset and liabilities. Funding liquidity and market liquidity can both dry up for fundamental or for non-fundamental reasons. So we need a lender of last resort and market maker of last resort permanently on standby. But moral hazard is created, excessive risk-taking is encouraged when market participants know that the enhanced lender of last resort, the market maker of last resort, is there to pick up the pieces should significant systemic damage be done. So the interventions have to be at penalty rates, at punitive prices. I'm not clear, I could not figure this out from any of the communications that were publicized, whether the Bank of England's gilt purchases since what was it, September 23rd or 28th to October 14th, whether they were on penalty terms. They should be on penalty terms. Better, of course, than the terms available or not available in the disorderly market, but below the price that would prevail in an orderly functioning market, the fundamental price. So the central bank has to have the capacity to model the prices of the assets that it's intervening in as market maker of last resort. Or indeed, it has to do the same thing for the collateral it accepts. The wider range of collateral it accepts as, if it acts as an enhanced lender of last resort. Okay. Further lessons. You can't do lender of last resort, market maker of last resort operations when the foreign currency denominated loans are involved. At times, apparently, sub-investment grade securities are purchased by a market maker of last resort facility. I consider the PEP, the Pandemic Emergency Purchase Program of the ECB, to have had MMLR, market maker of last resort, as well as non-standard expansive monetary policy and fiscal dominance characteristics. So a given set of asset purchases can have multiple motivations and multiple consequences, as indeed did the asset purchases under the GILT program, which were non-sterilized and therefore constituted expansionary monetary policy. So why the Monetary Policy Committee did not have to approve these actions is unclear to me. Here was an expansionary monetary policy action, including the postponement of the start of the rundown of the asset purchase facility, which did not require, apparently, a formal approval vote by the MPC. It's important, I think, when you engage in collateralized lending and asset purchases, and for financial stability reasons, to differentiate them from expansionary monetary policy by sterilizing the purchases. Sometimes the scale is simply too large. The Fed bought $1 trillion worth of treasuries in 3.5 weeks, starting in the middle of March, when the US Treasury bill market was seizing up. That clearly would have been hard to sterilize immediately, but sterilization should take place as soon as possible. Okay, the questions here, what are the questions? I'm just going to quit. Should the central bank intervene in the equity markets? I say no, Bank of Japan does. Should they intervene in commodity markets? I say no, but the Bank of England is of course engaged in lending, in guarantee operations for banks that are lending to distressed energy companies, merging what I would call a quasi-fiscal targeted intervention with a market maker of last resort intervention. It should also be sterilized. The primary markets, the secondary markets, I think both. All right. Quitting here, the international lender of last resort, too often missing in action. Won't have time to go into that. We can discuss it later. Onward. Central banks are beneficially owned by the government, no matter what the formal ownership structure is. So one thing I really like about the Bank of England is that it's very clear who the owner is. It's a joint stock company, 100% owned by the Treasury. So none of this nonsense that we have with the shares, equity in the Bank of Japan trading on the stock market and the Italian debt, equity in the Bank d'Italia being owned by the banks it's meant to supervise and regulate. There's all kinds of nonsense, even a weird ownership structure in the US. Forget all that. They are beneficially owned by the state, by the central government. And they can, of course, issue irredeemable liabilities, and their interest rates influence the cost of servicing the public debt, and they're highly attractive sources of funding for fiscally, financially challenged governments. Okay, we have been through that. Many reasons for purchasing government bonds, let's get to the fiscal dimension. The continuous time version of the government budget constraint is here. What matters is the non-monetary debt of the consolidated general government and central bank. You have to consolidate both. It's the interest rate, effective interest rate, real interest rate, minus the growth rate of GDP times the debt to GDP ratio, minus the painful component, the primary surplus of the state as a share of GDP, and minus the prima facie painless way of controlling debt emissions, which is seigniorage, which is changes in the stock of central bank money, net of any interest paid on the outstanding stock of central bank money. Right? So this is an identity. I like identities because they tend to be correct. If you integrate this over time, you get the intertemporal budget constraint of the state if you impose a no Ponzi game solvency constraint. The non-monetary debt of the state has to be serviced by equal in present discounted value to the future stream of primary surpluses, painful, tax increases, public spending cuts, or the present discounted value of future seigniorage, prima facie painless. And the discount rate is the interest rate minus the growth rate. And there's a painless element I'll get to in a second as to whether this intertemporal budget constraint might not exist, because the interest rate, effective interest rate on the public debt is now in a lasting way below the growth rate of real GDP. Answer to that is very brief, it's no. Okay, Fed's holdings of treasury securities during the period since the great financial crisis gone up from 5% to 25% of GDP, and the Bank of Japan, the winner, has gone from 12.6% of GDP to just over 100% of GDP now. 96 at the end of 2021. The monetary consequences of this fiscal largesse are clear from the behavior of the monetary base. As a share of GDP, in Japan, it went from 16.5% in 2007 to 127% of GDP, annual GDP this is. These are staggering numbers. The Fed is slightly less impressive, but still from 6% to 27%. The Bank of England from 4.6 to 46, and the ECB from 9 to just about 50% of GDP. So in the past, increases in monetary base of that magnitude have always been inflationary. The central bank consolidated assets tell a very similar story. I won't go into the details, but you can see here that just for the Bank of Japan, assets are now 133% of annual GDP. The Bank of England has gone from 6.5 to 46% of GDP. And the Eurosystem from 16 to 69% of GDP. That's the consolidated assets. Now, the reason inflation is still so modest is that broad money hasn't kept up with narrow money. If you look at what's happened to sterling M3 and to other M3s as a share of GDP, it has gone up significantly, but nothing like the increase in the monetary base. So the money multiplier, broad money relative to narrow money, has come down dramatically, especially in the UK, where it went from 25.6 in 2007 to 3.3 in 2021. That's the most spectacular decline in the money multiplier of the four central banks that we're looking at here. This causes me to lie awake at night, incidentally, because I think if there was ever any restoration of historical normality to the broad money multiplier, unless there was a massive contraction in the monetary base at the same time, we could see a serious burst of inflation on top of the one we already have. Question, is there a painless interest rate less than growth rate solution to the debt sustainability conundrum? The brief answer is no, and I basically believe that ex-ante private saving rates and public sector saving rates are going to be declining relative to planned investment, and that therefore the neutral real rate will be increasing in the years to come. The demographics and I would say lack of public sector discipline together take care of the saving. Robust planned investment is basically technology driven. So the intertemporal budget constraint of the state remains a binding constraint. There's no free escape. When there is a conflict about monetary funding between the government and the central bank, right, the winner almost always, historically, has been the government. The only exception to these rules that I can think of were the pre-Euro area Bundesbank, where the collective memories of hyperinflation gave it effective independence, the ability to say no. And then I was expecting that the ECB, which is one central bank, right, facing 19 ministers of finance, each of whom, relatively speaking, is a dwarf, right, even the largest one, that they would be able to hold their own against pressure to monetize deficits. But this turns out to be not the case. Okay, two dramas, I won't be able to go into them. Argentina since 2017 and Sri Lanka since 2019. They both had inflation targets of 5% or between 4 and 6% in the case of Sri Lanka. They both have ended up with sovereign default and inflation in Argentina now running at 78% and inflation in Sri Lanka in the 50s, I think. I haven't actually looked at it. Oh no, 60, almost 70%. So complete and utter fiscal capture. The central bank simply monetized whatever the government could not finance internationally. It could not, because nobody was willing to lend to it anymore, and it could not finance domestically because there's no domestic bond market willing to lend, and the ability to raise taxes or cut public spending is politically constrained. Let's, the ECB is my favorite example, I'm almost done, is, I think, engaged in monetized public debt purchases that pose a material threat to its price stability mandate. It has stopped purchases net under the PEP, right, since March 2022. But it is continuing to reinvest the maturing principal until the end of 2024. And guess what it's investing in? It's not investing in the stuff that matures necessarily, it's investing disproportionately in the fiscal instruments issued by fiscally weak governments. In 20 and 21, the funding by the ECB was 120% of the combined government deficits of the euro area. And I have some data here for the weak brothers and sisters in the euro area. Under the PEP, Greek sovereign debt purchased up to 21.1% of GDP in 2 years' time. Portugal, 16.4%, Italy, 16%. This is not expansionary monetary policy consistent with the price stability mandate, in my view. This is fear of provoking a sovereign debt crisis, which of course then would interfere with the function of the monetary submission mechanism. And that then becomes the official label for the intervention, maintaining the singleness of the monetary policy. But it's just a euphemism for saying subsidizing the fiscal issuance of the fiscally, financially weak brothers and sisters in the euro area. Okay. What is required for a central bank to maintain its operational independence in pursuit of price stability, to avoid fiscal dominance? Legislation is not enough. There has to be broad-based political support for low inflation, and if necessary, for painful fiscal measures in preference to monetary issues leading to higher inflation. That is a very difficult political equilibrium to maintain, to sustain. And it will be an interesting experiment to see in the years to come whether we'll be able to get inflation back under control in areas where public resistance, I think, to higher taxes or public spending cuts to bring the sovereign deficits under control is going to be a robust and constant reality. Yes, people dislike inflation, but they may dislike the alternative more. So I think the case for fiscal capture in the euro area is, I think, plain as Bagstaff, but in other regions, including possibly the UK, including the US, including Japan, similar phenomena may be at work. Okay. Central banks have three simple tasks. First, they have to relearn inflation control. Recognize that painless, immaculate disinflation is unlikely to be on the menu, and act swiftly and purposefully while long-term inflation expectations are still under control. The lender of last resort and market maker of last resort responsibilities have been greatly enhanced as a result of the growing importance of non-bank financial intermediation and financial markets in the financial intermediation process. This can at times interfere with the pursuit of price stability. I don't think it's possible to do much about that as long as the financial stability objective is legitimate. It is a systemically important market we're talking about. I don't think that means going much beyond public debt. Central banks must be able to resist fiscal dominance, have the political support of the population at large, and the ability to say no whenever monetization would pose a material threat to price stability. I wish every central banker luck in the years to come.